Hello and welcome to the Stockout. This is your show at FreightWaves for all things related to the CPG and retail industries. I'm your host for today, Mike Baudendistel, head of intermodal solutions at FreightWaves, FreightWaves Sonar, I should say. So I spend most of my time following the data side of the business, helping most Sonar customers with anything they need on intermodal, but also follow the ocean industry and drayage industry. And today we're going to be digging into the ocean industry and hope to have a guest, if he can figure out how to join in, John McCown, who really knows the ocean industry inside and out, has a tremendous amount of experience in the ocean industry. But before I do that, I'll give a little bit of an overview. So we have some background. Last week, the largest ocean carrier, Maersk, reported earnings, and they had some interesting things to say. I mean, one of the things they talked about was how they think that ocean spot rates have peaked from here, have a sonar chart, to that effect, if we could get that up. And so basically what Maersk said about ocean spot rates is that, from here, they expect demand to decline seasonally as we get a little bit later into the year, which tends to be the case, after you get through sort of the traditional peak, shipping season, combined with capacity that's coming into the market by about 2 to 3%, per quarter. And so it's logical that the ocean spot rates have sort of peaked. So far, they've looked had two kind of peaks earlier this year. I mean, there was one in about February when the Red Sea attacks started. It did seem like, after that situation, the industry seemed to have adjusted for that. But meanwhile, the ocean container volume continued to be strong. And that combined with some of the other knock-on effects with the Red Sea situation caused disruptions. Like one of the disruptions was congestion around the world, particularly Port of Singapore really had a lot of congestion. Some of that was related to having to adjust for the Red Sea situation. There was an international container shortage, so all those things caused another spike in ocean rates. So that's been one thing that has been. So there's the ocean spot rates sort of year to date. So I think you really had two events. You had the Red Sea situation, which was January into February. Things normalized to a certain extent, and then I think the run up that caught everyone by surprise started in about May, and you had that huge surge up. It seemed like the carriers themselves weren't expecting that. Some of the investors I talked to that trade in and out of these stocks weren't expecting that either. But for the shippers, which are really the primary intended audience of the show, this has a big impact on contract rates. And our guest today is going to describe this in a little bit more detail. So if we could bring on today's guest. Do we have John McCown?
Good morning, Mike. Pleased to be with you.
Yeah, great to see you. Yeah, thanks so much for joining me.
So it's a very interesting times in the ocean space. I think you covered the Red Sea is kind of the big thing, and of course with container ships in that lane, which is fully 25% of the worldwide container miles going the longer way around, it's about 1/3 longer. It has the effect of immediately kind of taking out 8% of the capacity. So we've seen that effect, and of course it wasn't just limited to Asia, Europe. It's kind of spread throughout the system. But what I think is really kind of come on particularly strong in the U.S. is just what's going on with the volume, and it's been surprising to me. And I look at the kind of the year-over-year volume, and we're kind of well past the point where we have easy comparisons. And the U.S. inbound volume has just really been ripping. It's first 6 months of this year, it's up about 15%, which is in worldwide volume is up about 7% over that same period. So that's kind of above the recent trend line, but the U.S. is where it's really strong. And the combination of that capacity constraint with Red Sea and higher volume is done, what would expect from rates. When you talk about pricing in the sector, though, I continue to kind of come back to the importance of looking at the aggregate pricing. There are a whole bunch of spot indices out there, some less credible than others, and those really are just kind of giving you a snapshot of a relatively small part of the market. What I really rely on in terms of seeing what's going on with overall pricing is the container crate statistics data that comes out monthly, and they have something called the Global Pricing Index, which again, all of this data comes directly from the carriers, and that is showing continued strength. And with that, we're going to see the earnings here in the sector, ramp up. Certainly, I don't think anywhere near where they were at the height of COVID, but nice, strong earnings, quite different than the industry has had in the past.
Yeah, I mean the carriers have guided up. I think Maersk guided up their earnings like 3 consecutive times. So it's certainly has caught them by surprise. It is hard to give Wall Street guidance. But from that perspective, yeah, I mean it's shippers should still expect to pay more. Wanted to ask you, I mean the volumes really have been tremendous, and you mentioned it was surprising. It is surprising in light of a consumer that does seem to be under pressure. You see things like credit card balances at 1.1 trillion and some of these statistics that are kind of scary. But sort of how do you sort of reconcile that with the average consumer being under pressure? Do you think that's a pull forward, or do you think that's inventory replenishment, or just any thoughts there?
Well, I think I hear people talking about kind of the pull forward. I don't see a lot of that. I think there is some. I guess one of the catalysts people talk about is concern about the ILA situation and not wanting to get kind of caught up in that. But it's been going on so long that I think it's just some. Quite frankly, just underlying strength in the economy that is a little bit different than what we see in the other, other measures. So and with that, the carriers are taking advantage of it. We now have a situation that, and to kind of reference the ILA situation, which is concerning, and fully one half of containers in the U.S. kind of come over ports covered by the ILA, and a coast-wide strike would be real chaos. But with that chaos, probably would be a situation that rates would spike up. So you have kind of ironically the carriers in a situation where their pricing and their earnings. Perhaps would benefit from a strike. I'm not suggesting that they want that to happen, but I think we're kind of in a little bit of a new world based on what the carriers have seen and kind of learned during COVID, where issues that lead to constraints that have the effect of reducing capacity end up being quite good for them. And so I think you're going to see much more active management of capacity on the part of carriers, and I think the notion that the industry would kind of go back to the financial results it had prior to COVID, which would put it, among the lowest performing industries, I just don't see that as taking place. So to get back to your question, though, in terms of what's driving it, I don't really have the answer. I try and focus on what has actually happened, and I will say that the volume is very strong. You referenced Maersk results. Maersk in the second quarter, continued to kind of overperform or underperform relative to some of the carriers that have already come out with their results. I take Maersk numbers and kind of go down to a net income by kind of allocating. At least they've moved away from only reporting EBITDA, which I think is a terrible measure in a capital-intensive business. But I think they report EBIT. But I take it down to net income, and that still has them at about 5% net income to revenue, which was well below the other companies that have reported. I think CMA CGM, which is the most comparable, was close to 9%. The Japanese companies, one was about twice that at 18%. So I think you're going to, I understand completely why Maersk has raised their earnings. Their third quarter earnings will absolutely be meaningfully above their second quarter. And you can kind of see that with to go back to this CTS Global Pricing Index, there's a lag effect in terms of spot pricing and filtering into kind of contract rates. And again, the contract rates definitely do not reset at the then current spot rate across the board, but there is some effect. But if you look at the June CTS index, they come out with a pricing index that is based on 100, based on 2008, and coincidentally, in June of this year, the index was right at 100, meaning pricing is the same as it was in 2008, non-inflation adjusted. But the average index for all of the second quarter, global pricing index, was 91. So that tells me that there's already a lot of pricing already in the pipeline. And Maersk, you can kind of go through the math, but I think you'll see Maersk automatically have a nice ramp up in net income here in the third quarter.
All very interesting. So how do you think all this will influence the carriers' decisions on spending capital and adding capacity in the industry? And that comment from Maersk where they talked about how they expect 2 to 3% additional capacity in the industry per quarter. Is that kind of what you see as just sort of a gradual increase because there was more orders put on during the pandemic?
Yeah, we certainly had a shipbuilding order book that was at record levels, and it was up to, if you measured it on a TEU basis, it was about 30%. But I don't think the TEU is necessarily the most relevant measure, because most of those new orders were for ultra large ships. So if you reduce it down to number of ships, it's 15% or thereabouts. That's still a very big order book, but if you kind of take into account just the physical replacement, you need something in the order of 3%, 4%, 5% just for that. And then you take into a little growth. It's not as concerning to me as some people have said. And I think the overlay of that is to kind of recognize that the carriers now have a different operating model, and I think you're going to see more active management of capacity. Some of those vessels will replace vessels that perhaps aren't physically reach the limit of their life, but from a emissions standpoint, from a fuel efficiency standpoint, they're kind of there. What has surprised me very much so, that order book was largely kind of slowed down significantly, or the ordering was kind of really before the pandemic. Some of those ships had been delayed, but in the last few months, even last couple of quarters, you've started to see a whole bunch of ordering going on. I think just a couple of days ago there was an announcement by C-SPAN to build some 27 container ships. Maersk is back building. You have a lot of new buildings coming on, by industry experts or the carriers themselves, with full knowledge of what's going on, in the market in terms of capacity. So I think that's a combination of a number of factors, but first and foremost, continued growth in the container shipping sector, and perhaps a comfort level more than ever that capacity, when it comes, will be introduced in a more disciplined way. You already kind of see it and have seen it, with carrier management and the blank sailings where, they take advantage of kind of reducing capacity. So it's, again, I would say to see the amount of ordering we've seen recently, given, the existing order book, can only be interpreted as a bullish sign by the carriers on, both the continued growth of container shipping. And one of the other things that, besides container shipping, I peg the growth at 2 2.7% a year, which is certainly below the historical level. I think it'll at least be that. One of the things you're also seeing, a subtle advantage of container shipping, is it is pulling cargo that moves in some of the other specialized trades. The most obvious case would be refrigerated vessels, which still exist, but now the largest really reefer ships in the world are container ships. You have that with other specialized commodities. Fully 25% of America's agricultural exports now move in containers. And what's happened is that the container ships have gotten so massively huge that they're kind of combining that scale advantages and a very subtle advantage that container shipping has over the other modes that really can transfer to stuff that moved in specialized ships is the loaded utilization of container ships. Because you have a differentiated cargo base, they will often operate at 75, 80%, overall utilization in both ways. You just don't have that in the specialized trades, which tend to be loaded one way, empty the other. And so the best they're going to have is 50% utilization. So that kind of cross-cannibalization of containerization against the other trades, is something that I think is going to continue to play. And, I think the carriers are fairly bullish about their industry going forward.
Yeah, that's a really interesting dynamic, pulling cargo from other things. You mentioned the carriers managing the capacity that's in the water. I mean, things like blank sailings. One of the comments the other day was the fact that the vessels are going sort of full speed, and that they could potentially use slow steaming to manage some of that capacity down. Do you have a sense of how much of an impact that would be if they were to do that?
Well, that's certainly been a tool that has been used in the past, and the Bloomberg terminal has these slick graphs that kind of show that by vessel type, kind of on a real time basis, and that has been something that has been used to kind of meter capacity. I don't, and that is something, and for much of the past when that was done, it was not only a capacity management, but it was when fuel was kind of significantly higher than it was now. And so when you slow down, obviously your consumption per mile reduces. So I think that will continue to be kind of in the toolbox of that capacity management that you see. And of course, the alliance structure brings with it an ability to fine-tune capacity that carriers didn't have when they were operating their own string of vessels. And it's kind of the simple math. If you kind of think of, say you have a given alliance that might have, 4 carriers with, 5 ships each and 20 sailings a week. If they decide to blank one of those sailings, that's a 5% reduction in capacity across the board. If you didn't have that alliance, the only way of blanking that capacity would be an individual carrier, sidelining one of their 5 ships, which is a 20% reduction in their capacity. So that's almost kind of an advantage that the alliances have in terms of fine-tuning capacity reduction they don't have. But so the blank sailings have continued to be used more frequently. I think the tool of speed adjustment is another one, and that's really kind of a bit more of a fine tuning. And again, when they do that, they tend to always have the slower speed on the backhaul leg, so it doesn't impact transit time for the key market as much.
Yeah, that makes a lot of sense. Wanted to ask you about ocean-going container availability. That was something that we heard issues of earlier in the year. Kind of happened all of a sudden. It seemed like I follow intermodal closely, and it seemed like intermodal carriers were willing to move the ocean-going containers from, let's say, the ports of Long Beach to Chicago, knowing that they could reposition those. And all of a sudden, we heard reports of container availability shortage. Are you seeing issues there?
I'm not haven't heard of anything along those lines. In fact, what I'm more aware of is kind of the opposite, because when Obviously, during the pandemic, as everything kind of got into a gridlock, and there was a need for more containers. Container manufacturing ramped up. You can build a container, in 4 or 5 months, and so there were orders for additional containers that were above the typical. But as that whole supply chain, as that Gordian knot kind of loosened up, what happened was really almost the opposite. You saw containers return into the system, if you will, and I'm frankly more aware of situations where stacks of empty containers have piled up, causing kind of storage problems. So I really haven't heard recently of that being a particular issue.
That's good to hear. I wanted to ask you about. I mean, you do a lot in your newsletter about the port market share. A lot of that was really interesting. I mean, a couple of things that stood out to me was that in the past year or so, the port of Long Beach has grown faster than the port of LA. So why is that? And then another question is, if you look at over the 5-year period, the port of Houston has been the fastest growing port in terms of imports. Why has Houston grown so fast?
Well, I think Houston benefits two reasons. One, and the most important, is really just geographic. And I've written a lot about what has been a rather consistent movement over years and really over decades of the entry point of containers to the U.S. There was a time right after double stack started that something on the order of 75, even 80% of containers came into the U.S. via the West Coast. And back in those days, actually, there was a conference system where the conference charged the same rate, whether it went intermodally, which got it there, say to New York 8 or 9 days earlier, or all water. Well, guess what? People chose the faster way if it didn't cost them anymore. Those days are obviously gone, but you still have, roughly kind of a 50-50 mix of containers breaking over the West Coast versus the East and Gulf Coast. And the reality is containers in the end, or the cargo in containers, goes where people are. And so if you kind of go through the population centers, and remember that, once you get past California, there's kind of a relatively empty space. Only about 25% of the population on the mainland can be more economically served, if costs are the only thing, by freight coming over the West Coast. So I don't think the ratio is going to get down to that, but I do think it's going to continue to move. And so that transition to the East and Gulf Coast is really just geographic, and also those areas, particularly on the Southeast, are growing a little bit quicker. Houston had the further benefit of being it particularly benefited during the relocation of some freight due to the West Coast congestion and later strike problem, because it was really kind of the closest port, if you're going to detour to the East or Gulf Coast port. The other thing that I would point to that's perhaps more than a subtle advantage is Houston, as well as the faster growing East Coast ports, which would be Charleston, Savannah, Norfolk, are all kind of have a different operating model. They're referred to as operating ports, as opposed to most of the other. The traditional model was a landlord port. And when you're a landlord port, you really just rent the land to people, carriers, or terminal operators. When you're an operating port, you're involved to different degrees in kind of running the actual port itself. And when you're an operating port, by definition, that requires management that have more direct knowledge of container shipping. And I think that translates into the results. I think there are a lot of small things that perhaps get lost in the cracks if you're a landlord port that isn't the case if you're an operating port. So Houston's container shipping operation is modeled as an operating port, and I think you're seeing the advantage. And Savannah, of course, really kind of wrote the book on how to manage a better port operation. And with them, Savannah's really the port that kind of initiated, let's focus on marketing to the ultimate customers, the Home Depots, the Targets. Let's get a distribution center, and once we have that, the carriers will come. And that's obviously been copied, and that's the smarter way of doing it. But that tack likely would not have occurred to a landlord port where they're really only interested in leasing their land.
Yeah, all really great insights. All those things you don't think about just looking at data, but all that additional background is great. John, we are out of time. How can people reach out to you, sign up for your analysis that you send out, et cetera?
Please just send me an email at my email address, john.d.mccown, MCCOWN, @gmail.com, and I'll be pleased to put you on my distribution list.
Great. Well, thanks very much.
Thank you, Mike.